Hello and welcome. Have you ever watched a professional poker player playing? Watching them maintain an icy calm while everyone else at the table is on edge. They know that one impulse move can cost them the game. Now imagine applying that same level of discipline and control to your trading. How much more successful could you be if you could keep your emotions in check and avoid these irrational decisions? Today, we're going to go through one of the most critical aspects of successful trading, managing trading impulsivity. In today's presentation, we're going to look into the causes behind impulsivity, how to identify it, and most importantly, how to overcome it. Today's presentation is all about empowering you to take control of your trading behavior that will lead you to long-term trading success. So, by the end of this video, you'll have actionable strategies and tips to help you trade more calmly and effectively. At the end of this presentation is also a guided affirmation video that you can listen to daily. It was created by myself to help traders like you introduce a state of emotional calm, which will help you focus and find clarity, also whilst improving your trading mindset and performance. All you need to do is sit back, relax and listen with headphones as the affirmations go deep into your subconscious mind. Now, let's dive into the actual presentation so you can start to learn the art of mastering your trading emotions. So, what is trading impulsivity? Have you ever experienced this? What did it feel like and what happened? Did you experience the rush of adrenaline, the quickened heartbeat, and the sudden urge to act without thinking? In the trading world, impulsivity can be devastating. It can lead to irrational decision-making and emotional-driven decisions in the markets. So, understanding trading impulsivity. Now, trading impulsivity is an emotional and psychological state where traders act hastily, driven by gut feelings or emotional reactions. This typically involves reactions to market volatility. Sudden market movements can trigger knee-jerk reactions. For example, a trader might hastily exit due to fearing further losses, only to realize later that the market has corrected itself. The pursuit of quick, substantial gains can also lead to reckless behavior. This includes making trades based on, social media hype or trends without proper research and risk management. Next is overtrading. Engaging in excessive trading without a plan or sticking to the plan can result from an attempt to recover previous losses. We'll talk more about the psychological factors now behind impulsivity. So, several psychological factors contribute to impulse trading behaviors. The fear of losing money can cause traders to exit trades too early, whilst greed can push traders to overtrade. Also, another factor is overconfidence. Traders believing too strongly in their self or their ability can lead to reckless trading actions and an outcome. Next is peer pressure. Observing others' trading successes or movements can really compel traders to copy, often without understanding the underlying reasons. Now, the consequences of trading impulsivity are huge. Significant losses, emotional stress, decline of capital, and this continuous impulse trading can really deplete confidence, reducing the ability to participate in future opportunities. And we're going to talk more about the causes now. So the causes behind impulse trading. Picture this. You're at your trading desk or station. The market is moving fast, your heart is racing, and you feel this overwhelming urge to make a move. Does that sound familiar? Because it does to many traders. Now let's look into this and why this happens and how you can start to gain control over these impulses. First up, let's talk about emotions. As we know, these drive impulse trading. Now imagine yourself holding a trade and suddenly the market starts to turn. Fear kicks in. You panic, you sell, only to watch the market bounce back. Now flip the coin. The market is moving quickly and you feel like you're missing out on huge gains. Greed takes over, or FOMO, and you buy without a second thought. Emotional reactions lead to poor decision making. It is vital to invest in your psychology and learn how to manage your emotions. Overconfidence Now let's discuss overconfidence. This overconfidence can be destructive. I've seen it so many times with traders. Now, whilst confidence is key in trading, overconfidence can lead you down a risky path, and we've spoke about this in a different presentation. Be mindful to read the signs. Generally, this happens after a series of wins. FOMO, the fear of missing out. This is probably the biggest one apart from the fear of losing. Now, I'm sure you felt the sting of FOMO. The fear of missing out can push you into making irrational decisions. Remember, the market will always have opportunities in the future for you. Patience is your best friend. Loss aversion is another biggie. This can make traders hold on to losing positions for way too long, hoping for a turnaround that may never come. It's like being in a sinking ship and refusing to jump into the lifeboat because you believe the ship will magically repair itself. So, how does impulsivity affect traders emotionally? Well, let's talk about the first point, anxiety and stress. First and foremost, impulse trading can skyrocket anxiety levels. Now, the uncertainty of the outcome can lead to constant worry and stress. You're glued to your screen, second-guessing every move and losing sleep over potential losses. Regret and guilt. Now, when an impulse trade goes wrong, regret and frustration are quick to follow. You may start to replay the decisions in your mind, thinking about all of the steps that you skipped and the plan you ignored. The self-blame can be emotionally draining and really affect confidence. You might even start to doubt your ability as a trader. Next, we have emotional fatigue. Constant impulse trading will lead to emotional fatigue, and that's a fact. The highs, the lows of quick trades can create a volatile, emotional environment. Now, one moment you're elated, perhaps there's a quick profit. The next, you may be devastated by a sudden loss. This emotional seesaw can really take a toll on the nervous system, mental well-being, which can often lead to burnout if not managed well. Next is lack of discipline. Finally, impulsivity really erodes discipline. Trading requires a real strategic, disciplined approach, but impulsivity replaces strategy with chaos. Over time, this lack of discipline will only lead to a downward spiral, and this is where emotional decision-making becomes the norm rather than the exception. Impulsivity doesn't just affect your trading account, it affects your emotional and your mental well-being. So it's really important to recognize these emotional impacts, which is the first step to taking control, and then developing a good discipline approach to trading. So, how do you spot the signs of impulsivity? Let's talk about this now. Recognizing these red flags will only help you make better, well-formed decisions going forward. So how can you identify when you're trading on impulse rather than logic? First of all, it's about emotional reactions. Start paying attention to your emotional state. Are you feeling anxious, euphoric, or overly excited when making trades? Emotions are the major driver of impulsivity. If you find yourself making decisions based on a gut feeling or a rush of adrenaline, then there's a clear sign that you're trading impulsively. Another part is lack of analysis. That's another red flag. Skipping your usual analysis. If you're entering trades without checking charts, reading your reports, and just jumping in, then this is another sign. Frequent trading. Are you making a number of trades in a short period? Over trading is often a symptom of impulsivity. Now, if you find yourself constantly entering and exiting positions without a clear strategy, it is time to reassess your approach. Another sign is chasing the market. Do you often find yourself jumping into trades because others are making profits or because you see a sudden market movement? This is a classic sign of FOMO. Chasing the market without solid strategy will lead to significant losses. The next is ignoring risk management, and I've spoken about this many times, but it's so important to stick and have good risk management. Next and finally is post-trade regret. Do you often regret your trades shortly after making them? This regret usually stems from realizing that you act without sufficient planning or analysis. If you frequently experience post-trade regret, then it's a strong indicator that impulsivity is at play. So by recognizing these signs, it will help you identify impulse behavior. Now for the good part of the presentation. techniques for managing impulsivity. Now, there are several evidence-based techniques and strategies that can build greater self-awareness, emotional regulation, and discipline. Here are 6 effective techniques for managing impulsivity. Now, they may not be commonly considered, so let's go on to these. The first one is intentional delay. So, what I mean by this is rather than acting on impulses immediately, intentionally delay your response by implementing a cooling off period. When you feel the urge to make an impulsive trade, commit to waiting for an amount of time before taking action. Use this time to conduct a thorough analysis of the trade. Consider the potential risks and rewards and evaluate whether the trade aligns with your trading plan. This intentional delay introduces a pause between impulse and action, and it allows you to make more rational and well-informed decisions. Now, the next one is, and we've briefly spoken about this, mindful observation. Practice mindful observation of your thoughts, emotions, and physical sensations when faced with impulse urges. So instead of reacting automatically to impulses, take a moment to observe them without judgment or attachment. Take a breath. Notice where you feel the impulse in your body, what thoughts are coming through, and how it affects your mood. Now, by developing this awareness of your impulses, you'll start to learn and even disengage from them, and you'll choose a more productive course of action. The last one is environmental modification. Invest in your trading environment. So the next one is environmental modification. Invest in your trading environment to create a space for disciplined decision making. This may involve decluttering your trading desk, eliminating distractions, or establishing clear boundaries between your personal space and your trading space. Now, creating a calm and organized environment really minimizes external noise that may contribute to impulsive behavior. How to remove trading impulsivity? This is a really good question. Constantly removing trading impulsivity requires a consistent, proactive approach. Now, while it may not be possible to eliminate impulsivity altogether, you'll be able to perhaps develop strategies and techniques to manage and reduce its effects. Now, here are several effective methods that you can use. Next, physical anchoring. Use physical anchoring techniques, as I've mentioned before, to ground yourself and interrupt impulse decisions. When you notice the onset of impulsivity, engage in a physical action that serves as an anchor to bring you back into the present moment. Now, this could be as simple as taking a deep breath or even tapping your fingers in a specific pattern, say. Now, by associating these physical actions with a pause in impulse behavior, you can train your brain to recognize, disrupt these impulse patterns more effectively. Next on, and I've spoken again about this many times, is visualization and affirmations. Really try and incorporate at least one of these practices into your daily routine. They really help. And so the last one is an accountability partner. Maybe partner with a trusted accountability partner or a trading buddy who can help you stay accountable to your trading goals and commitments. Share your trading plan, your rules, your goals with your accountability partner, and establish regular check-ins to review your progress. Maybe you can discuss any challenges or impulse tendencies you may be experiencing. It will really help. Now, having an external source of support and accountability will really provide value, perspective, and encouragement, which will help you to stay on track. Now, by implementing at least one of these techniques for managing impulsivity in trading, you're going to gain better self-awareness, discipline, and resilience, and reduce, of course, the impulsivity.